Welcome back to our show. You're listening to Brashonomics here on Monday afternoon. And, well, when it's Monday, you get the pleasure, as do I, of talking. Well, you get the pleasure of listening.
The pleasure, huh? We'll take that.
Yeah, absolutely.
That's new.
The pleasure of listening to Ryan Leopold from Cobalt Mortgage with nearly $1 billion in loans funded. He knows his stuff about financing. And, well, first, welcome back, Ryan. How are you?
I'm awesome, Ben. How you doing?
I'm awesome, too. So, you know, we hear about, well, we've heard about new houses and why you might buy a new house versus an old house. We've heard about parks with neighborhoods and the reasons people buy into a community. But most people don't necessarily have the cash to just go buy a house. I would say 90% of people are getting mortgages, maybe more. I don't know the percentage. What are some of the ways that you're hearing about, or what are some of the big things people are talking about in the mortgage world as far as financing and the ways to do that?
Yeah, I don't know if necessarily talking about it. I think it's just understanding. I think buyers need to understand just kind of how financing works these days and how it's maybe different than it was 5 years ago, because especially when buyers are coming back to the market who haven't been financing in 5 or 6 years, they're kind of used to the old way of doing stuff. And so we almost have to retrain them in a way to understand how mortgages are done today and kind of the categories of loans that are available, so that way we can clearly articulate what option makes the most sense for them and their financing goals moving forward.
And when people have that financing goal, I know a lot of times you'll start asking people, well, you know, what are some of your goals? And most people are just like, I just want to buy a house.
Yeah.
You know, it's tough to tough for people to grasp the fact that their mortgage is so integrated with their financial plan. I mean, it's their biggest debt, their biggest monthly payment. So when you start getting into the typical ways to do that, it's the loan programs that kind of help people reach those goals, isn't it?
Well, you know, I think our job is really to make the whole process a lot easier for people to kind of understand and navigate through. So what I tell people now is the first thing I kind of tell people is first, we only have really 2 boxes in the mortgage world at all. And 95% of all the loans are done in this one box. And that one box is going to be conventional Fannie Mae, Freddie Mac stuff, FHA, VA, and USDA. And really on the low end, USDA and VA aren't done really as much around here. So most of the loans, 95% of the loans are probably in that conforming or FHA box. So it's really understanding the difference between those two from not only from a loan amount standpoint to see if you qualify for that box, or from kind of which one of those two in most cases makes the most sense for your situation. And then the other 5% really is just anything that's outside that box. It's kind of jumbo stuff. So it's kind of the higher loan amounts where you need maybe more like 20% down. And those are just kind of different boxes. Where in the past, there would be maybe 40 to 50% of loans were Fannie Mae, Freddie Mac, FHA stuff, and 50% were loans put together by multiple different lenders. So you had hundreds of boxes on that right side that you could choose from in multiple different categories. And that's probably where the biggest thing has changed over the last couple of years is kind of this 2-box theory.
There are less boxes.
Simplify it.
Less boxes than under my Christmas tree. So let's get into the typical way. I mean, so you talk about Fannie Mae, FHA. How does one know if they're going to fit in the big box of loans?
Well, you know, not a lot of consumers really know for sure. And so sometimes we have buyers come to us who maybe have met with lenders in the past, and they come in and say, I'm FHA and I want to know what your best interest rate is on an FHA mortgage. I'm like, well, okay, wait a second. FHA is not the right mortgage loan program for everybody. Let's understand your situation to see which box you kind of fit into. So the best way to do that is give a quick rundown of the difference between conventional and FHA and understands kind of some of the positives and negatives between the two. Sound fair?
Absolutely.
Okay. So FHA is a popular loan program, there's a lot of negatives to it. But some of the positives are is you can put as low as 3.5% as a down payment. Okay, and that 3.5% can be a gift from a family member. It's pretty good. Okay?
Sure.
You know, you don't have to have perfect credit on FHA. Okay, you can get away with less than perfect credit. But there's going to be mortgage insurance. There's not only monthly mortgage insurance, but an upfront mortgage insurance premium that's pretty costly that people don't quite understand until they go through the numbers. So that's probably kind of the basics.
Yeah, I mean, a lot of that upfront mortgage insurance, I mean, that's an upfront cost that kind of eats into that 3.5% down you think you're putting down. It takes some of that money in some ways, or some of the equity anyways, and pumps it into a mortgage insurance pool. Yeah,
it's a lot more expensive today than what it was 6 months ago and even 12 months ago, and that's continuing to increase. just because the losses that have mounted on past FHA loans because of the fact that because of all those positives, somebody could buy a house with 3.5% down, doesn't have to be their own money, and you don't have to have perfect credit. And it's pretty loose as far as your income stability, as far as jobs you've had in the past.
And then what about the monthly? I mean, because you're going to have mortgage insurance on most loans if you don't have your 20% down in one way or another. What's the monthly look like on the FHA comparatively to maybe not going to an FHA loan?
Okay, so let's talk about one. You have a monthly mortgage insurance premium. It's kind of locked at 1.25%. And that's 1.25% of your loan amount. So that can be pretty expensive.
It's like adding 1.25% to the rate.
It really is, actually, absolutely. Okay, and they're going to finance in an upfront mortgage insurance premium of 1.75% that's financed into your loan for the life of the loan. So that's, almost another 2 points that's added into the loan.
So in the first year, you actually pay 3% of your loan amount in mortgage insurance.
Absolutely.
That's expensive.
For the benefit of buying with 3.5% down and not having less than perfect credit. So some people come in and they think that FHA is the way to go because a lender told them that was the case. Our job is to understand their overall position and say, okay, FHA could be an option. And honestly, you only want to go that direction if you have to, because conventional may be a better route, but we got to see if you fit into that box or not.
Okay, so let's get into why conventional may be better than an FHA loan, because I think a lot of people go out there and they're like you said, they come in, I'm FHA. And there's a lot of people who just think, well, it means first-time home buyer, which is not right. It's your federal housing authority. But that's just, it's people with misinformation that just put themselves in that box. And like you said, it can be very expensive, but it's common, so people just gravitate towards it. And maybe people don't necessarily work with somebody who goes, well, because FHA is easy. FHA is like, yeah, you go to an FHA loan. It's easy. There's, and nobody's going to question it because it's government loan, government insured. But now you get into the conventional side, which actually can save you a whole bunch of money.
It could, and I think that's what a lender, at the end of the day, that's what a lender's real job. There's two major parts of what a lender should be doing. Number one is educating and informing their clients about their options to help them navigate that pre-approval / approval process. And this is a big part of it. And second part, which is probably even more important, is once they actually find a home, is getting that loan closed. Okay. But to answer your question, on the conventional side, you have to do a minimum of 5% down. Okay, and that 5% has to be your own money. It has to be your own money that you saved over time. It can't be a gift, even if it's from a family member. You can get a gift from a family member, but if you put 10% down, at least 5% of that has to be your own money. Okay. Credit interest rates are very much based on credit score. So the better your credit, the better your interest rates are going to be. So if you have a 680 credit score as opposed to a 780 credit score, it's going to be a big difference on interest rate. And then if you don't put 20% down, you're going to have mortgage insurance in some capacity, but there's a lot more flexibility with the mortgage insurance on a conventional loan. A, it's a lot less expensive. B, there's a lot more flexibility of how you can utilize it to reach an objective of creating the best financing package for you and your family. So you can be monthly, you can finance it in, or you can pay it all up front and put 3 to 5% down and have it no mortgage insurance at all. So a lot more flexible, but I think where people kind of get stuck between the two is, well, I don't have 5% down. Well, either A, you're going to have to save it, or FHA is available if you can get a gift fund. B, my interest rate's a little bit lower than perfect. Your mortgage insurance is going to be a lot higher. Maybe FHA does make sense. Okay. Or if you don't have the job stability, like you've been in your same industry and your same job for 2 years, maybe FHA is the better way to go. Okay. So conventional and FHA, they're both different, but if someone can go in the conforming box, it just tends to be cheaper and a more efficient way to go.
Well, and, with mortgages, they're not sexy, but everybody just wants to save money. I mean, that's all. I just want to save money on my mortgage. Just want to save money on my mortgage. The problem is that a lot of lenders don't necessarily know how to give people the options that save them the most money. They know how to give them one option that may work.
True. And I think our job, too, is also to present to them in a way that allows a buyer, whether a first-time home buyer or somebody who's done this multiple times, to grasp the information and be able to make an educated decision. It's not our job to make a decision for them. It's our job as a lender to give them the information, coach them through the process, and give them all the tools they need to make the best decision for them and be there for them.
Ryan, thanks so much for joining us again. Ryan Leopold with Cobalt Mortgage. When we come back, we're going to bring everybody back to the table, including TC Hyatt and Michael Busaka. Ryan's going to stick around, and we're going to get a little bit more of Heather Moore, who's going to join us, and we are going to discuss more about what's going on here in the real estate world. We'll be back after this break.